Hello Lana, welcome to Manifested e-learning forum. My name is Emlyn Ngwiri and I'll be taking you through alternative investment analysis. We are looking at September 2015, which is the pilot paper, question 2. Question 2A reads as follows: explain 4 alternative exit strategies in private equity and their impact on value. So we are looking at September 2015, which you're saying is pilot paper, question 2. So A, the 4 alternative exit strategies. What we need to understand is that we will start by looking at how private equity actually operates. Private equity begins by identifying investors who provide the much needed financing, invests in the private equity firm. The private equity firm now goes ahead and tries to identify those investments or those forms of companies which are considered viable for them to consider investing. So they invest in portfolio of companies. The portfolio of companies could be from different asset classes. Different asset classes could be from manufacturing, could be to education. We could be able to also talk about maybe even healthcare and the like. In return, they end up getting ownership as the general partners, and by extension, these investors end up getting ownership in the form by being limited partners like that. As general partners and limited partners, the individuals who or the institutions that have got what we can say limited liability is the general partners there. So the first individuals to be compensated are the general partners. Then we move ahead and provide an investment to the limited partners there. Now there are some clauses that must be signed between the general partners and the portfolio of companies, as well as the general partners and the investors, the key investors of the limited partners right over here. Those clauses or those contracts that must be signed between the two on both ends needs to be stated in what we call say some form of writing like that, so that can be able to be binding. So we are saying it should be in form of a legal document there. So we are saying that trying to answer September 2015 question 2A, at what options exist for the portfolio of companies to exit being managed by the private equity firm. So for example, the private equity firm pumped money to, say, company 1 right over here, 5 billion shillings. At the end of 8 years, the company's value is worth 25 billion shillings. Now, because the private equity firm has pumped money into this firm and re-engineered the business processes within the firm, how much they want to now exit from being managed by this firm so that they can be able to get the 25B. The difference between the 25 and the 5B, which you're saying is 20 billion, is considered profit for the private equity firm. The private equity firm, I said, is considered as general partners. So there has to be a contract that explains the distribution of profit between the general partners and the limited partners there. So the first way is what we're saying, an IPO, or an initial public offer, where the company's shares can actually be floated through an exchange. The second way of exit is through a management buyout, where the management team of the private equity firm could be able to use a lot of leverage so that they can be able to now get that much needed financing to buy off the company. The third way of how to exit is through a secondary sale, where you can be able, where the private equity firm, because it's the one that owns that company, it can sell it to another company for strategic reasons. Probably maybe it's in the similar line of business. If that company is dealing with the production of bottles, then it would be good to sell it to a strategic investor that also deals in the manufacture of bottles there. Number 4, we talk about IPO, MBO, secondary sale, and liquidation. So we're saying if the company, this company right over here, the portfolio companies may not be performing very well, then the assets could be liquidated so that they, if they don't find the company being viable, they could be able to just sell it off or sell the assets to probably interested investors. So these are the 4 major exit routes or strategies that are applicable in private equity. So we can now put it in writing and say following. So number 1, initial public offering. We can say a company's equity. You can say a company's equity may be offered for public for public sale, and this exit route results in the highest exit value. That. So simply put, companies' shares are offered for sale. Second way of how private equity firms can perform their exit is liquidation. We can say this is the outright sale of the company's assets. And we can continue and say when the company is can move on this side, is deemed no longer viable or no longer a viable investment there. So you can be able to liquidate the assets so that you can be able to get you can be able to realize some value. Then those proceeds you can be able to now consider investing it in a viable venture or another venture capital investment. The third method is secondary sale. Secondary sale, we can say the company is sold to another investor for strategic reasons. A company could purchase the private equity portfolio companies or company if it feels that the purchase would add value, there. So we are looking at these three squares, if you allow me very quickly. At this point, this bond exists with the private equity firm like that, and this is the portfolio of companies there. So what it can do is that another strategic investor over here can be able to purchase these companies' assets, or rather can be able to purchase this company if it feels that it's going to create some form of synergy there between these two companies there. Probably some synergy could be in form of cost efficiencies and even in terms of maybe research and development like that. So that is why we can be able to consider secondary sale as another exit route in private equity investments. Now let's look at the fourth one. The fourth one is management buyout. Management buyout. This is where I had mentioned that the management team of the private equity company goes ahead and purchases the portfolio of company if they find it a viable investment for themselves. There, so we say it refers to the process by which the company or the management team rather, the management team of the private equity firm purchases using debt financing, the portfolio of companies. So the management team goes ahead and takes a loan so that they can be able to invest in the portfolio of companies like that. Those are the four exit routes that are applicable for private equity investments.